Another day, another story. Modifying accounting data for managerial decisions. Modifying accounting data for managerial decisions involves adjusting financial information to provide more relevant and accurate insights for internal decision-making within a company. Here's a detailed explanation of modifying accounting data for managerial decisions. Cost allocation and cost behavior analysis. 1. Direct and indirect costs. Managerial accounting may allocate indirect costs, overhead, to specific products, projects, or departments to understand their true cost contributions. 1. This helps in pricing decisions and resource allocation. 2. Fixed and variable costs. Analyzing cost behavior helps managers understand how costs change with changes in activity levels. 2. This information is critical for planning, budgeting, and determining break-even points. Relevant costs and decision analysis. 1. Relevant versus irrelevant costs. In decision-making, only relevant costs, costs that change due to a specific decision, should be considered. 1. For instance, when evaluating whether to accept a special order, only incremental costs and revenues are relevant. 2. Opportunity costs. Managers consider the potential benefits foregone by choosing one option over another. 2. These costs are not always reflected in accounting records but are vital for making informed choices. Special orders and pricing decisions. 1. Pricing strategies. Managers might modify accounting data to assess the impact of different pricing strategies on profits. 1. This involves estimating changes in sales volume, variable costs, and contribution margins. Make or buy decisions. 1. Comparing costs. Managers analyze the costs of producing a component in-house versus purchasing it externally. 1. They may modify accounting data to include relevant fixed and variable costs for accurate comparison. Budgeting and performance evaluation. 1. Flexible budgets. Managers use flexible budgets to assess performance at different activity levels. 1. Modifying data to create flexible budgets helps in evaluating variances more effectively. 2. Variance analysis. Actual performance is compared to budgeted figures, allowing managers to identify areas of concern and take corrective actions. Capital budgeting and investment decisions. 1. Cash flow analysis. Managers modify accounting data to calculate cash flows associated with investment projects. 1. This involves considering initial investment, expected future cash flows, and salvage value. 2. Discounted cash flow (DCF) analysis. Adjustments are made to account for the time value of money, helping managers compare the present value of future cash flows against the initial investment. Segment reporting and performance measurement. 1. Segment profitability analysis. Managers modify accounting data to calculate segment-level profitability. 1. This helps in identifying the most and least profitable business segments. 2. Transfer pricing. Accounting data may be adjusted to set appropriate transfer prices when goods or services are transferred between internal departments or divisions. Inventory valuation and costing methods. 1. Cost flow assumptions. Different costing methods, FIFO, LIFO, weighted average, impact inventory valuation and cost of goods sold. 1. Managers may choose a method that aligns with specific managerial goals. Non-financial information integration. 1. Key performance indicators, KPIs. Managers integrate both financial and non-financial data, such as customer satisfaction scores or employee productivity metrics, to gain a holistic view of performance and make well-rounded decisions. Details of market value added, MVA, and economic value added, EVA. Market value added, MVA, market value added, MVA, is a financial metric that measures the difference between the market value of a company and the capital that has been invested in it. It focuses on determining how much value a company has created for its shareholders over time. MVA takes into account both the company's market capitalization, stock price multiplied by the number of shares outstanding, and the total capital that has been invested in the company, common equity plus debt. Formula for MVA. MVA equals market capitalization total capital invested. Key points about MVA. 1. Positive MVA indicates that the company has created value for shareholders, as the market value exceeds the total capital invested. 2. Negative MVA suggests that the company's market value is lower than the total capital invested, indicating a potential lack of shareholder value creation. 3. MVA is used to assess a company's long-term performance and its ability to generate returns for shareholders. 4. MVA is a measure of a company's market worth, and is sensitive to changes in stock price and capital structure. Economic value added, EVA. Economic value added, EVA, is a performance measure that evaluates a company's ability to generate economic value above its cost of capital. EVA focuses on assessing how well a company's operations are generating returns for both shareholders and creditors, considering the cost of capital as an opportunity cost. EVA takes into account a company's net operating profit after taxes, NOPAT, and the capital employed in the business. Formula for EVA. EVA equals NOPAT, capital employed times cost of capital. Key points about EVA. 1. EVA is a more comprehensive measure than traditional accounting-based metrics like net income, as it factors in the cost of capital. 2. Positive EVA indicates that a company's operations are generating returns that exceed the cost of capital, thus creating value for both shareholders and creditors. 3. Negative EVA suggests that a company's returns are not sufficient to cover the cost of capital, indicating potential value destruction. 4. EVA encourages management to focus on projects and activities that generate returns higher than the cost of capital. 5. EVA considers both income statement, NOPAT, and balance sheet, capital employed, elements to provide a holistic assessment of a company's value creation. Depreciation. Depreciation is an accounting concept used to allocate the cost of a tangible asset over its useful life. It reflects the reduction in value of the asset over time due to wear and tear, obsolescence, or other factors. Depreciation is important for accurately matching expenses with revenues in the accounting period in which the asset is used to generate income. Here are the key details about depreciation. Methods of depreciation. 1. Straight-line depreciation. This is the simplest and most commonly used method. 1. It spreads the cost of an asset evenly over its useful life. 1. Formula. Cost of asset residual value, useful life. 2. Declining balance depreciation. Also known as accelerated depreciation. This method applies a higher depreciation expense in the earlier years and decreases over time. 2. It's based on a fixed percentage, such as double the straight-line rate, of the asset's book value. 3. Units of production depreciation. This method allocates depreciation based on the actual usage or production output of the asset. 3. It's particularly useful for assets that are used more when production is high. Factors affecting depreciation. 1. Cost of asset. The initial cost of the asset is the starting point for calculating depreciation. 2. Useful life. The estimated period over which the asset is expected to be used or provide economic benefits. 3. Residual value. Also known as salvage value. This is the estimated value of the asset at the end of its useful life. 4. Depreciation method. The chosen method affects how depreciation is calculated and allocated over time. Impact on financial statements. 1. Income statement. Depreciation expense reduces net income, which affects profitability. 2. Balance sheet. Accumulated depreciation reduces the carrying amount of the asset, influencing the company's equity and financial position. 3. Cash flow statement. Depreciation is added back to net income when calculating cash flows from operating activities since it's a non-cash expense. Thanks for watching. Don't forget to like, share, and hit the notification bell to stay updated with our latest videos.